Hey everyone, welcome back to Corporate Decoder. Today we are diving into Sky Quarry's latest quarterly report. And let me tell you, after looking at these numbers, I'm not sure if they're digging for oil or digging themselves into a hole. It's going to be rough. Basically, Sky Quarry is trying to make money by recycling asphalt and extracting oil, which sounds good for the environment and their wallets, but are they succeeding? In short, their sales went down, they lost money, and they're worried about staying in business. If you find it interesting getting to the bottom of all this boring stuff, then make sure to subscribe. Don't forget to check out our Discord community, link in the description. Sky Quarry is a real company. They filed this report called a 10Q with the Securities and Exchange Commission, or SEC. It's basically a quarterly checkup for publicly traded companies. This report covers the first 3 months of 2025, so we're talking January, February, and March. Keep that in mind. Also, just so you know, the information in the report is as of May 15, 2025. Let's get into the numbers. First off, assets and liabilities. These are what the company owns and what it owes. Accounts receivable, that's money owed to Sky Quarry by its customers, went up, meaning people are buying more on credit. Inventory, the stuff they have to sell, went down, meaning they sold more of their stock. Their property, plant, and equipment, basically the things that help them make products, went down. This could mean things are getting old or they sold something. Oil and gas properties, meaning oil that is still in the ground, went up. So they are betting on future oil. Restricted cash, money that is locked away for specific uses, went down a lot. Finally, goodwill, which is what a company is worth beyond its physical stuff, stayed the same. Overall, assets are down from about 27 million to 24 million. Switching to the liability side, their accounts payable, what Sky Quarry owes to other companies, went down. That could be good, meaning they're paying bills. They have lines of credit. And that amount has almost doubled. Also, their notes payable, which are kind of like a promise to pay back a loan, are about the same. Finally, their warrant liability, which we will explain later, went down. Overall liabilities are down from 15.4 million to 15 million. In a nutshell, liabilities didn't change as much. Finally, we get to shareholders' equity. This is what's left over if you sell everything and pay off all debts. Preferred stock and common stock are basically the same, but preferred stock gets paid first. Additional paid-in capital, which is money from investors, went up a bit. Accumulated deficit, which is losses over time, got worse. It went from about 24 million to 27 million. Overall, shareholders' equity went down from 11.5 million. Big picture, that's not a good trend. Let's look at how they're doing. Let's look at the income statement. Lead net sales, which is how much they sold things for, went down from about 11 million to 6 million. They lost money instead of making money. $726,000. This time last year, they made $569,000. Operating expenses, meaning what it cost to run the business, stayed about the same at around $1.6 to $1.9 million. And there were some other things that affected the income and loss, with losses on paying off debt and valuation on company stock. Overall, Sky Quarry lost about $3.3 million, about 16 cents a share. Last year, they only lost about 2.4 million or 15 cents a share, so another bad trend. There's also something called other comprehensive loss. This is mostly due to currency changes, and it was minimal this time around. The statement of shareholders' equity, which we're about to get to, shows how the ownership of the company changed over the 3 months that we care about. XT looks like some debt was converted into shares, and some shares were based on compensation. Time to look at the cash debit. It basically shows how much cash the company brought in and spent. Net cash used in operating activities, meaning what they spent to actually do business, was negative almost $2 million. To compare, last year was only about 1.2 million, so not good. Cash flow from investing activities like buying equipment was also negative, about $316,000. Proceeds from sale of assets as well as purchase of plant, property and equipment are to blame here. Cash flow from financing activities, things like loans, was also negative, but only $24,000. There was a large decrease from lines of credit. But mostly the fact that 2 of these 3 categories are in the negative doesn't give you a warm feeling. I want to just quickly cover a few highlights from the notes to the financial statements. A company will use financial notes to explain a few topics better. Sky Quarry basically says they are refining, extracting oil, and cleaning the environment. They also say that their accountants have some doubt that they can continue as a business, which makes sense considering all of these numbers. This means that the company may not be able to pay its bills. Through their subsidiary 2020 Utah, the company acquired leases to be able to dig for oil from Utah State. They spend a little bit of money doing this every year and will end in 2030. This refers to company machinery which depreciates over time and needs to be replaced. This is where Sky Quarry talks about their oil and gas business. A key takeaway, they are still in the process of getting equipment and assets for their work. Next, let's talk about their assets relating to land. The company leases office space and leases remote camp accommodations, which are classified as finance leases. Goodwill is a way to count what a company is worth outside of its real assets, and this stays the same. This is what the company owes to other people, and at the moment it is 3.2 million. Warrants are like options, but they are issued by the company. They allow the warrant holder to buy company stock at a certain price. They have to be valued and can influence whether a company is making profit or losing it. Lines of credit are the ability for the company to borrow money as needed. They also have security agreements. The company has a lot of debt. They pay a lot of money to service this debt. The loans have maturity dates ranging from about half a year to 1 year. Finally, there's convertible debentures, meaning bonds that can be converted to company stock. This one has a maturity date of 2026. Here are the parts of the world that Sky Quarry gets the most revenue from, which comes from refined products like diesel and asphalt. There is a plan to pay employees using company stock known as a stock option plan. The company commits to paying for leased land in return for operating in Nevada. Finally, there are things that occurred after the period but still have to be reported, such as agreements to sell debt for cash. Tough deal. So what do we have here? Sky Quarry's in a tough spot. They're trying to make money in multiple ways, both refining oil and recycling to get it. However, their sales are down, their costs are high, and they are losing more money than they are bringing in. The company also has a lot of debt. Finally, they depend on being able to borrow money in the future to do more than survive. While the plan is good on paper, the high debt load and negative cash flows mean that they are walking on very thin ice. Any disruption or major issue that slows them down can put the company in a really bad spot. For now, Sky Quarry is one to watch, but not necessarily invest in. Alright, that was our breakdown. What do you think? Is Sky Quarry going to turn things around, or are they in too deep? Leave a comment down below. If this analysis was valuable, hitting that like button really helps, and make sure you subscribe for more deep dives. Also, don't forget to check out our Discord in the description where you can share your knowledge. Thanks for watching. See you next time.